Because the Strait of Hormuz closure has choked roughly a fifth of global oil supply, Australia's diesel price has surged 75% this year to nearly $3 a litre, and that single cost line is now restructuring which ASX miners survive and which don't. The mechanism is straightforward but brutal. Open-cut mining operations depend on diesel-powered trucking fleets and generators, and Bell Potter estimates diesel already accounted for up to 15% of operating costs before the conflict began. With that base now multiplied, the S&P ASX 200 Materials Index has entered bear market territory, and brokers are actively rotating clients away from large open-cut producers toward underground and in-situ operations. Macquarie flagged Western Australian iron ore direct shippers as particularly exposed, estimating only 3 to 5 weeks of diesel supply remain in the Pilbara. Mineral Resources Hub there faces the sharpest squeeze, while Fortescue stands apart. Its pre-conflict decarbonization program, which Substitute now translates directly into a cost advantage of $3 to $6 per ton. If diesel prices hold above current levels through the June quarter, producers relying on open-cut methods will face margin compression that consensus earnings estimates have not yet priced in. That structural damage has not stopped the ASX from bouncing hard today, but the reasons matter. The ASX 200 jumped roughly 150 points as two forces combined. February inflation printed at 3.7% against a forecast of 3.8%, and oil slipped back below covering drove the move more than conviction buying. The energy sector itself fell even as the broader index rose, because oil producers like Woodside and Santos lose revenue leverage when crude eases, precisely inverting the trade that had worked during the conflict's escalation phase. The RBA's position, however, is not improved by a single soft print. February's 3.7% headline figure remains above the bank's 2 to 3% target band, and it was recorded before the oil shock's full transmission into domestic fuel and transport costs. Analysts at Commerzbank noted the inflation data keeps the RBA under pressure despite the modest beat, and forecasters at The Age warned headline CPI is on track to push past 5% by June as energy price rises ripple through freight, food distribution, and utilities. The RBA faces the worst inflation fight in a generation, precisely because the shock is supply-driven. Rate hikes cool demand but cannot produce more oil. If the Hormuz situation stabilizes and oil retreats decisively, the RBA gets room to pause. If the conflict extends into the June quarter, the bank will be forced to choose between hiking into a weakening economy or allowing inflation expectations to drift higher.
Against that backdrop, the federal government's decision to co-invest $2 billion to secure the future of the Boyne aluminum smelter in Queensland carries a logic that goes beyond industrial policy. The smelter, operated by Rio Tinto, is one of the largest electricity consumers in Australia, and its survival is increasingly tied to the transition to renewable-powered green aluminum, a product that commands a premium in European and Japanese markets, where buyers are paying up for a low-carbon metal. Rio Tinto's share price rose on the announcement, reflecting the market's reading that the deal locks in a long-term asset that would otherwise face closure under rising energy costs. Critics on the political right framed it as a renewables-driven bailout, but the structural argument runs the other way. Without grid-scale renewable power, the smelter's energy bill under fossil fuel pricing makes it unviable regardless of the subsidy. The risk is timing. If renewable capacity does not scale fast enough, the government has committed capital to an asset that remains exposed to exactly the energy shock driving the current crisis. One clear countersignal to the diesel disruption thesis came from Alliance Aviation Services, whose shares surged nearly 20% after the company clarified that its business model provides near-complete insulation from jet fuel volatility. Under Alliance's wet lease arrangements, airline customers bear fuel costs directly. Contract customers are subject to automatic fuel repricing clauses. The market had sold the stock down roughly 50% in 2026 on fears that rising energy costs would compress margins, but today's update showed those fears were misapplied. The risk sits with the customer, not with Alliance. The reaction illustrates a broader dynamic playing out across the ASX. Investors are differentiating sharply between companies that absorb fuel costs and those that pass them through, and stocks where the pass-through mechanism is contractually guaranteed are being re-rated. The watch points from here are three: whether Hormuz traffic normalizes before Pilbara diesel stockpiles run out, whether the June CPI print forces the RBA's hand before any easing in oil prices provides cover, and whether Rio Tinto's green aluminum bet can attract enough renewable capacity commitments to make the Boyne Smelter's long-term cost structure viable. Each scenario has a clear causal chain, and each runs through the same choke point that started this: the price of energy.